Thinking of selling your business? Here's what you need to know before you exit. If you're new here, I'm Abbas, a chartered accountant and chartered tax advisor. So let's start with the basics. There are really two main ways that you can own a business. Either you own the trading company personally, you're the direct shareholder, or your shares are held by another company, typically a holding company that you're the shareholder of. The difference in ownership can completely change the way a sale is taxed. Let's start with personal ownership. If you own shares in a trading company personally and you sell those shares, you'll usually be subject to capital gains tax on the profit. That's the difference between what you sell the shares for and what you originally paid for them. Though in practice, many founders acquired their shares for a nominal amount because you probably set up the company for £100. Now, if the company qualifies and you meet certain conditions, you may be able to claim business asset disposal relief or BADR. BADR means you pay a reduced rate of CGT on the first £1 million of qualifying gains over your lifetime. The CGT rate you pay if BADR applies is currently 14% on the first £1 million of gains, and then 24% thereafter. Now that 14% rate is rising to 18% from April 2026. If BADR doesn't apply, then most of your gain would be taxed at 24%. So what are the conditions for BADR? First, the company must be a trading company, not one that mainly holds investments or rental property. Second, you need to be an employee or officer of that company. And third, you must own at least 5% of the shares and voting rights. Crucially, you must have met these conditions for at least 2 years prior to the sale for BADR to apply, which makes planning ahead crucial. This might sound straightforward, but this is where people get caught out, especially if they want to involve, say, a spouse or partner in the business to use their BADR limit as well. If your spouse only becomes a shareholder a few months before the sale, they're not going to qualify. You can't fix this retrospectively. So if there's even a chance that you might be selling in the next few years, it's worth sorting out the structuring now, before any discussions with buyers even start. As always, if you have any questions, comments, or any topics that you want me to talk about next, drop them in the comment section below. That's it for this video. Thanks for watching.